Inflation is going to likely keep its pace over the course of your retirement. Next up, it's Gail from Little Rock. I've got $2.8 million in retirement savings at age 57. I don't plan to retire anytime soon unless something happens where I have to, so I feel like I'm pretty set. I'm worried about inflation, though. How do I know when enough is enough? And how do I keep my money from diminishing in retirement if inflation keeps its pace? Gail, thanks very much. And first, congratulations on acquiring or accumulating $2.8 million in retirement savings by age 57. You would have to be very diligent for a long period of time to be able to do that. So kudos to you for that, and you are very prepared from an asset perspective to walk into retirement. Now, she tells us that she doesn't have any plans to retire anytime soon. So we do need to probably walk through a scenario of when is your projected retirement date, or put a different way, when is your date of financial independence? It might be pretty close, right, with $2.8 million, but you need to set a date in the future of when am I going to begin to utilize what I have accumulated in assets as income to me, because that point in time is the first piece. And if you don't know, that's okay, but we got to start somewhere, right? Maybe it's 62, maybe it's 65, and it can always change.
And a lot of times people will pick a I'm going to be ready. And it does sound like, mathematically, Gail really is ready. If you don't have a date before this, we would lean towards picking age 65. It's somewhat arbitrary, but it's also because that's when Medicare is going to kick in from a health insurance side. And there's nothing that says if you plan for age 65 that you can't continue to work beyond that date. But as Scott was indicating, pick a timeline where you say, I want to know that I know that I'm ready to retire at that point. For me, it's 59 and a half. I plan to continue working beyond that, but I want to know that I'm absolutely ready at that point. So we would also encourage you to think about, you've looked at this at least in this question of more of an asset perspective, but retirement, we would say, is really more of an income problem to be solved rather than an asset problem to be solved. And we'll delve into that a little bit more, but if you came in with $2.8 million and you said, I just need a very small amount of income per month, and I'm also going to have Social Security, then you're great. If you come in and you need, quite a bit of income per month, and we see everything from small to large numbers on that monthly income need. If your income need is high, then you may not be in as cushy of a situation as it looks like at this point.
Yeah, so let's talk about the second part of her question. I'm worried about inflation, though. How do I know when enough is enough? Well, I think the first piece of that is we've talked about, right? We have to pick a retirement date in the future. That will allow us to see where your assets could potentially land in value based on what you're contributing and future growth. So you'll know how much you have, but knowing enough is enough is determined by the income plan. So that could be part of the equation to determine that. But to keep your money from diminishing in retirement if inflation keeps its pace, that's the second half of the question. No if there. Inflation is going to likely keep its pace over the course of your retirement. So you have to battle that in such a way that your investment strategy remains, at least with a piece of your portfolio, in a growth strategy. And I think for some retirees, this is easy to absorb, but for others it's not, because they will talk to us oftentimes in terms of, I've got to get out of the market ahead of retirement because I don't have time to make this up, right? If I lose 20% of my portfolio, I don't have time to make it up because I'm planning to retire in the next year or so. And they view, Janet, retirement as a full stop from an investment risk perspective.
Yeah, we've seen people view it as a full stop. We've also seen people view like there's no yield sign, there's no nothing. They just keep on going because the recency bias of if there's been a really good market, they think that's just going to continue. Things will always change. One direction or the other, things will always change. And I think this is a good place to share a story from years ago in Gen Wealth history. There was a lady, she didn't come to us until 2007. For today, we're going to call her Linda. We share her story in our book as well. But when she came to us in 2007, she was in a very different situation than when her retirement actually began. Linda was able to accumulate $1.3 million by the age of 50, and she decided to retire early. Now, when you retire before 59 and a half, and Gail, this is you for a little bit longer at age 57, when you retire before 59 and a half and you're taking income from your retirement assets, then there are some restrictions about how you do that. The IRS has some rules about you do a calculation and you have a set amount of income that once you start taking it, you have to take that amount, substantially equal periodic payments is what it's referred to, until either 5 years or to age 60, whichever is longer. You do have an opportunity to change it once, but only once. And again, it's still tied to only a few ways to calculate that dollar amount that you withdraw. So Linda had started taking income from her $1.3 million at age 50, but here's the key. That was in the year 2000. It had followed, the roaring 90s, if you will, when everything was on fire in the market. It was fabulous. But 2000 was the first of the 2000, 2001, and 2002. Those were the three worst years our country had seen since the Great Depression. So, Scott, we had there what we refer to as sequence of return risk. She retired into a down market and didn't know it at the beginning of 2000. So she went through those 3 years that were pretty atrocious in the market and was depleting those assets rather rapidly because there had not been a plan put in place for her to be able to withdraw income regardless of what the market gave her in return. So her returns were her income was very dependent upon the returns that they had seen in the 90s. That's not what she retired into. So by the time she came to us in 2007, she was 57 years old. She was still tied to that required income stream, that calculation of the substantially equal periodic payments, and her $1.3 million was down to $300,000. Scott, it was the worst appointment I've ever had in my life because I had to sit across this 57-year-old, the table from this 57-year-old grandmother and tell her, we can't help you. You're going to have to go back to work. Now, if she had come in at age 50 in 2000 with her $1.3 million, taking the approach of what we do as a flooring and bucketing strategy, Gail, that's what we do to be able to address inflation and to make sure that you're going to have that income regardless of what the markets give you, particularly early in retirement, Scott.
Yeah, so from an investment perspective, Gail, retirement is not a full stop. It is also not a keep doing what you've been doing that got you there.
Right.
The investment strategy has to change dramatically, and the control of the withdrawals is really what the bucketing strategy is all about. Now, the flip side of Gail's question is, how do I battle inflation? That's the growth end. The other end of the bucket is still exposed to the stock market in some diversified fashion. So if the market goes down, those assets will likely lose value in the near term. But what do we know if we keep going past 2003? This money is set up in your investment strategy to not be utilized as income. In other words, no investments are planned to be sold for potentially 15 years. Well, let's go out from 2000 to 2001, 15 years. Where would we be, right? 2015. We've had a surge of growth since that time frame. So it's built to let time heal the wounds in the market, let it continue to grow. And the reason you need to do that is, back to your inflation question, Gail, you have to be invested in asset classes that have historically outpaced the rate of inflation, because your dollar, your buying power, is going to diminish flat out. And so you have to grow beyond the rate of inflation. And there are only two asset classes in history that have done that, and that's the stock market, or stocks, and real estate.
Yeah, Gail, I think the underlying principle here is control what you can control.
Yep.
You cannot control what the markets are going to give you. You may not be able to control when you retire. Some people get that opportunity, some people do not. What you can control is how you invest those assets relative to an income plan that should be structured so that it will work regardless of what you can't control, like the market.
You've done a great job, Gail, acquiring wealth. Now let's make a plan to make sure that you carry it on through the rest of your life with the income that you want.